Hello and welcome to the latest ARC Spotlight. I'm Tom Lemmon and I'm delighted to be joined by Colin Behar, who's a portfolio manager at USS. Welcome, Colin. Thanks for being here.
Good to be here.
So Colin, for those who maybe aren't super familiar with USS and your sort of ABS platform, do you want to just give a quick rundown of how that works?
Sure. So USS is a UK-based pension fund, and a few years ago we started a direct investing mandate from USS into ABS, or securitized credit in Europe and the UK. So we started from the top of the capital structure and expanded to a broader array and a more diversified portfolio across the capital structure and across asset classes in Europe and the UK.
And how do you see the two markets sort of developing over the rest of the year? It's been a sort of flying start in sterling and a bit slower in terms of public issuance in euros, but what's your take?
I'd say the market is generally healthy, for lack of a better word. We have investors across the capital structure, the investor base broadening both at the top of the capital structure and at the mezzanine level in the higher risk part. Issuers are also coming to the market, so established issuers coming more often in some cases and using the market, for what it's meant to do, so which is tranche risk and kind of cater to the needs and preferences of different investors.
Why do you think the investor base is broadening?
I'd say stability over the long run is certainly helping. We've seen the market over the past decade or so go through a number of events and various broader market gyration, and still do just fine, both in terms of actual performance, in terms of liquidity as well, which has been a concern for a while. And I'd say 5 or 10 years ago, we were in a market where the net supply was negative. So that wasn't very healthy.
Yeah.
That's kind of resolved itself over the years, and that's definitely a positive.
I guess sometimes what's interesting to me is that this characterization that securitization as a market has sort of got rid of its boogeyman status. You sometimes find that's a bit simplistic, but is that actually the case, that over the years it's just been performing as it should and more investors think, okay, well, let's go?
Yes, I think it has. I think also, even through, the great financial crisis a couple of decades ago, if you actually look at the realized performance of these assets through that period, the asset class has actually performed okay compared to other places in the market. Admittedly, a lot of ups and downs, or downs more than ups back then. But the realized performance for someone who would have held these assets back then, it was actually okay. So I think people over time realize that there isn't anything wrong with the tool. And more than that, people are now realizing that there is a great benefit to be unlocked through that tool and to fund the real economy. Yeah.
And do you think that the regulation proposals coming through, is there a sort of, are investors maybe getting ahead of that, getting comfortable with the asset class now in the hope that the market will grow significantly once those regs change?
Yeah, I think there's certainly a feeling of a slow but persistent regulatory tailwind. It's not a continuous process, and it's not a fast process, which you wouldn't expect from this type of thing. But yes, I think that makes more people more comfortable overall when regulators kind of see that securitization specifically as a positive force for funding the real economy and fostering growth.
And what do you do then? What are the sort of key things you're looking out for when you assess, like a new deal comes your way? What are the big factors that make you decide, yeah, I'm interested, or no, I'm not?
Well, I guess there are 4 main areas for any securitized deals. One is the collateral, or the asset base. 2 would be the structure. 3 would be the sponsor, the manager, the originator, and 4 would be the pricing. I say because we've set up the mandate not too long ago, we've managed to set it in a very we didn't set us too many constraints, too many undue constraints, and therefore, in any of these 4 areas, I don't think. Well, we're trying not to put ourselves to too many constraints that would mean we can't invest in any deal. That being said, obviously, if you could have a very low quality or riskier collateral or something that can have a wider array of outcomes, but then if that's managed by a very experienced manager, if the structure is very protective, and if the pricing is really attractive, you can still find benefits to it. So it's really these combinations between these 4 factors that are relevant. Obviously, we would still have some red lines in terms of making sure the cash flows do go to repay the debt, and there are things like that we can't negotiate on.
I'm just wondering, so we've seen so much spread compression, I guess, between different asset classes. It seems like the traditional prime asset classes have stayed relatively flat, and then your more esoteric deals just keep getting tighter and tighter. Does that then change your approach? Are you starting to look at different areas or different tranches even?
We certainly consider relative value between the different sub-asset classes in our market, and also the relative value to other asset classes away from securitization. Most asset classes in general are expensive by any stretch, historically. That being said, that additional spread you can get in most places in our asset class is still attractive compared to the realized performance over the past 10 years and most scenarios of that performance going forward. So I'd say yes, obviously spreads are tight historically, but there's still a positive spread adjusted for the risk of loss, which financial theory would call that an ARB, which shouldn't exist, but it does, and it has for a number of years.
So you're still happy even though it is a bit too tight?
Yes, we're also because securitization, generally we're investing in very short bonds compared to most other types of asset classes out there. Securitization, a new deal comes to the primary in ABS land, it's a 3-year, maybe a 5. You look at corporate bonds, they can be substantially longer than that. So it's more around, if you look at the long term as we are, it's not just the entry point of today's spread that matters. It's also how this spread will behave over the next 10 years.
If we look over the next couple of years, obviously we've got more investors at the moment, seemingly all the time, more issuers. Are we going to see more new asset classes? Obviously we've had things like solar ABS coming in the last couple of years. Anything else that was really sort of piquing your interest?
In general, a broad array of different asset classes is always good to, allow us to gain more diversity in terms of future performance, to grow the market, and in a more general sense to help fund areas of the economy that need it or that are growing. So solar panels or green origination is obviously an area where there's a big need for funding, and securitization can play a part in that. And we have the tools, albeit not a very long track record, but we have tools to assess it and model it. I'd say another area, surprisingly, that I'd love to see more of is on the primer end. So in particular in Europe, the market's barely used as a tool. You look at the US, you look at even the UK, funding prime mortgages through securitization is a very, very, very common thing. In Europe, not yet, and I think that could be, going forward, that could be a development that is positive both for the prime mortgage market in various countries in Europe and the securitization market as well.
Yeah. it's a bit tough to compete with covered bonds, I suppose, in places like Germany.
There are reasons why that is the case right now, but there are also reasons why securitization can bring something different to the table in terms of risk transfers. But we then enter a world of regulation and reasons why that might or might not work in the future.
I guess the last couple of years have been sort of typified by volatility in a way, at least in terms of newspaper headlines and geopolitics and things like that. How do you, as an investor, deal with that? Are you just ignore it, or?
No, to that last question, definitely no. That being said, I mean, when you look at the market movements related to these potential risks, I wouldn't say the market is ignoring them, but certainly not pricing them in, and certainly not pricing them in for very long. We've seen that kind of buy the dip attitude persist, and you know, it has been a successful strategy for the past number of years. I'd say because we're a long-term investor, I'll come back to that because that's really core to everything we do. I think we would generally put more weight and price more highly these tail risks. In general, we'd run more stresses, we'd look at them perhaps a little more closely, both in terms of market tail risk, in terms of asset performance tail risk, and in terms of structure-related tail risk, so counterparty and counterparties going bust, or unforeseen things happening on the collateral that have an impact because the structure has specific features. These things we would spend, I think, more time than others looking at and value more than others.
Rather than reacting to the news.
We also have the flexibility through our mandate to move the dial up and down in terms of risk. But obviously we're not a hedge fund. We're not looking to trade in and out within a matter of days or weeks. It's a longer process.
Well, great. Thank you, Colin, so much for being here, and thank you for watching.